Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Jacobio Pharmaceuticals Group Co. Limited annual report. Jacobio Pharmaceuticals Group Co. Limited is a leading investment holding company specializing in the discovery and development of oncology therapies. The company's portfolio includes various clinical stage candidates that target specific cancer indications. One of its notable candidates is Glesarazib, JAB-21822, a KRAS G12C inhibitor being studied for several types of solid tumors, including non-small cell lung cancer, NSCLC, and pancreatic ductal adenocarcinoma, PDAC. Another key candidate is Sitnaprotifib, JAB-3312, an SHP2 inhibitor in phase III trials for NSCLC. In addition to these candidates, Jacobio Pharmaceuticals Group Co. Limited has a range of other clinical stage and IND-enabling candidates that target various solid tumor indications. These include JAB-2373, a pancreas inhibitor, JAB-2485 Aurora inhibitor, JAB-30355 Y220C reactivator, JAB-Zone100 and 2CD73 MOB inhibitor, JAB-26766 PARP7 inhibitor, and JABB-X300 LIF inhibitor. The company also has a collaboration agreement with Merck for combination trials of Cetuximab, further expanding its research capabilities. With its focus on oncology therapies and extensive pipeline of candidates, Jacobio Pharmaceuticals Group Co. Limited is poised to make significant contributions in the field of cancer treatment. The remarkable surge in Jacobio Pharmaceuticals stock price over the past year can be attributed to several key news events. One major catalyst was the collaboration agreement with pharmaceutical giant AstraZeneca for the co-development of its pancreas inhibitor, JAB-2373. This deal is potentially valued at up to $2.015 billion and provided substantial immediate cash flow and long-term value potential for the company. Additionally, Jacobio's KRAS G12C inhibitor, Glesarazib, received approval in China for the treatment of non-small cell lung cancer patients with KRAS G12C mutated tumors. This was followed by its inclusion in China's National Reimbursement Drug List, significantly improving market access and triggering a RMB 50 million milestone payment. The company also reported narrowed net losses and significant reductions in research and development and administrative expenses in its 2025 annual results. Furthermore, Jacobio made progress in its other innovative drug platforms, including the entry of EGFR KRAS G12D TADC and Hiart-Wostinga IADC into the investigational new drug, IND, preparation stage. The collective positive developments, particularly the strategic collaboration with AstraZeneca and the successful commercialization and pipeline advancements of its key drug candidates, have been instrumental in the substantial increase in Jacobio Pharmaceuticals stock price over the past year. Jacobio Pharmaceuticals Group Co. Limited, market capitalization of $5 billion, is materially smaller than most of its industry peers of roughly $26 billion. Jacobio Pharmaceuticals Group Co. Limited trades at a higher price-to-book ratio of 6.03 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 32% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This also raised the question if that management is diluting shareholders to sustain the business. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. If the business does not improve its revenue and generate positive cash flow, the company will continue to struggle to cover its cost and interest expenses. This combination makes the investment case highly unfavorable unless earning issue is addressed. On top of the cash-burning business, shareholders are consistently diluted. I may be wrong, but I would suggest to stay away from such investment for now. The primary drivers of revenue growth or decline are multifaceted, reflecting the dynamic nature of a company's financial performance. On the growth side, significant contributors include upfront payments from major partners such as AstraZeneca, potential milestone payments that could reach up to $1.915 billion, and tiered royalties on net sales of licensed products. Additionally, regulatory approvals like NMPA approval for AI-Rai-Ki, Glesarazib, in May 2025, inclusion in the National Reimbursement Drug List in December 2025, and solid sales performance by business partner Alist all contribute to revenue growth. Furthermore, clinical trials and development of certain drugs drive significant allocations of net proceeds, while commercialization activities for these drugs in China also receive notable allocations. Lastly, increases in trade receivable from contracts with customers and recognition of revenue from non-refundable upfront payments further boost revenue. On the decline side, a decrease in research and development expenses is a primary driver, accounting for a 42.9% reduction of RM-100 and $41.6 million. Additionally, a decrease in revenue from license-out agreement and related services agreements by RM-100 and $2.2 million also contributes to the decline. Furthermore, recognition of revenue from non-refundable upfront payments for licenses and collaboration agreements decreased, further impacting revenue negatively. The company's financial performance indicates a concerning trend of negative operating cash flow. This means that the company is not generating enough revenue to cover its operational expenses, resulting in a net outflow of cash from its core business activities. As a result, the company may struggle to meet its short-term obligations and invest in growth initiatives, ultimately impacting its long-term sustainability. The company's financial health has undergone significant changes over the past year, particularly with regards to its debt level and interest expenses. One of the most notable changes is the increase in the company's debt level. The total bank borrowings have risen by RMB 22.7 million, while non-current liabilities have seen a substantial 59% increase from RM 193,142 to RMB 307,403. This has also led to an overall increase in total liabilities of 22%, from RMB 435,988 to RMB 533,695. The company's interest expenses have also seen a significant jump, increasing by RMB 4.5 million from RMB 8.4 million in 2024 to RMB 12.9 million in 2025. Furthermore, the presence of variable interest rate debt indicates that there is potential for even higher interest expenses in the future. Overall, these changes suggest that the company's financial situation has become more precarious, with increased debt levels and rising interest expenses posing a significant challenge to its financial health. Management's outlook for the company is optimistic, with a clear vision for global market leadership. By submitting the IND application for Jacobio X467 in 2026, they aim to bring transformative therapies to the market. The company will focus on pursuing significant opportunities in KRAS target therapy and IADC fields, diversifying its portfolio of innovative therapies and AGs. Management is prioritizing the development of frontier KRAS portfolio for tumors with unmet medical needs, advancing allosteric inhibitor technology and IADC platforms simultaneously. This strategic approach will enable the company to capture global market opportunities through collaboration and partnerships, while also driving innovation and expansion into new areas of research. As clinical progress is made and regulatory approvals are anticipated, the company plans to add world-class manufacturing and commercialization capabilities to its platform. This will further solidify its position as a leader in the industry, enabling it to bring innovative therapies to patients worldwide. There is no notable activity in terms of acquisitions or divestitures. The company has not made any significant purchases or sales of assets, businesses, or subsidiaries that would be worth mentioning. This suggests a stable and consistent approach to business operations, with no major changes in the company's portfolio or structure. The company's financial policies have been scrutinized by investors and analysts. One key aspect that stands out is the company's dividend policy. According to available information, the company has chosen not to pay dividends to its shareholders. This decision may be influenced by various factors such as the company's growth stage, cash flow requirements, or strategic priorities. In terms of share buybacks, there is no mention of this practice in the provided summary. This suggests that the company has not engaged in any significant share repurchase activities. The absence of dividend payments and share buybacks indicates a focus on reinvesting profits to drive growth rather than distributing them to shareholders. That concludes the financial summary for Jacobio Pharmaceuticals Group Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.